Hi, everyone. Welcome back to Macro Matters. We are here on Monday, March 4th to talk about the markets on our bi-weekly Macro Matters podcast. As always, I'm joined by my colleague, Tony Zhang. Tony, good to see you
Yeah,
again.
yeah, good to see you, Rich. I think just over the past 2 weeks since our last episode, there were a lot of market dynamics going on ranging from AI to blockchain, cryptocurrency, Federal Reserve policy. I think there will be a lot of interesting things that we can go through in this episode.
There is a lot of stuff to talk about, like you said. And there's clearly a lot of investor exuberance we're seeing. We were just talking about some of the altcoins, et cetera, and then the moves that we've seen there. We'll get into that. But I think in particular, I thought it was interesting a lot of the economic data we got in the last week, which certainly doesn't scream hard landing, but I think it's starting to maybe show me some yellow flags that are out there. In terms of the ISM, the new orders, things seem to be slipping and not really accelerating the way you would expect to see with markets at all-time highs. But that's okay, because when it's all said and done, we still have enough good news to kind of continue us higher. But like you said, the first thing we wanted to talk about was the Fed, right? The Fed, what the market's pricing for the Fed still. That's always that's the big wild card, right?
Correct. Well, this is a very interesting things that we always like to talk about, and most of the time that market continue to make a very bullish and optimistic prediction over the action taken by Federal Reserve. If we recall last year that the overall market really anticipated Federal Reserve is going to cut maybe even 3 times by the end of last year in 2023. And now once we actually enter into the year 2024, right at the beginning, that market really anticipated that we are going to have at least 4 cuts. Okay. Now afterwards, we with all of the data like coming in, not only that we always see the number of cuts will be going down from 4 times to at least 4 times to now right now no more than 3 times. The
Yeah,
data.
so those that are watching on YouTube, and for those that are on the podcast, I brought up my Bloomberg and bring up the screen WIRP, which always lets us look at what the market is pricing in for these Fed funds futures, as Tony's talking about this. So you can see there the number of cuts that are being priced into the market that Tony's talking about.
Correct. So this number is very interesting. So we can see even by the end of this year. So mainly the most likely scenario there will be 3 cuts. But right at the beginning of this, we actually anticipate at least 4 cuts. In the early time that the Federal Reserve is going to cut will be in March. Now we actually it's right now formally get into March, and the chance for us to have a cut in March is close to zero if nothing materializes. That the earliest time that we can see that the Federal Reserve might actually cut have been shifted from May to early June, as what we seen here. This is the most likely scenario. So here, this is something that what we continue to talk about in our Macro Matters episode, that don't be just over optimistic about the action that could possibly be taken by Federal Reserve, given the current very strong and resilient economies underlying, and the inflation and same as the inflation number as well. Even though we continue to see the inflation number continue to go down, but because of the strong job employment data, most of the price hike and wage increase are still actually funded on some very solid foundations over there. That's my take, Rich. What do you think?
Yeah, I think you're right. I think the we're starting to see the impacts of the wage rounds that we saw last summer, right? And a lot of activity early last year and into the summer of last year on the labor front. We're seeing the benefits and weaknesses of that now, right? So if we remember, firms such as technology firms and financial services firms, software engineers, investment bankers were all getting fired. They were the first ones to get fired in big numbers, right? And
Correct.
those, not surprisingly, those are high variable cost industries, right? They don't have a lot of fixed costs. We call it asset light, but a lot of their costs are labor costs, and so the inflation was showing those labor costs going up, and they got ahead of it, and they fired a lot of people, and that surprised people. I think a lot of those jobs were absorbed by the other parts of the economy because the economy was doing okay. But what we see this Q4 earnings this year that have just kind of largely finished up that we'll look at in a few minutes is that the companies that did the best this Q4 period were the ones that were firing the most people early last year. They saved their margins, and that allowed them um, to deliver a lot higher earnings growth than the market was expecting. I think tech names were up on average about 40% in earnings, and financials were up double digits. They're up like 11% or so. So clearly the company's getting ahead of that has definitely benefited their earnings. Now, on the flip side, we saw a lot of labor unions and wage negotiations last summer, whether it be airlines, mechanics, pilots, flight attendants, or rail, truckers, other sorts of logistics companies like UPS, FedEx, et cetera, even Amazon. All of these firms were seeing labor unions and look for higher wages, go on strike in some cases, and we are seeing in Q4 and as we look into early Q1 and Q2, the expectation is that you know these higher wages that they have to pay are starting to hurt margins in those companies, and so we're definitely seeing the impacts on the labor market of this kind of these wage hikes, and that comes with the persistent inflation that we had seen as people are not irrational. They want their wages to kind of keep up with inflation, and that's all they were looking for. And as you saw, in most cases, the companies gave in pretty quickly, right? There was not a lot of extended negotiation on that, but that we're going to see that impact earnings. Um, but we'll talk about earnings. I want to touch base here a little bit on the Fed, as you were talking about. As you can
Yes.
see, about three-quarters of a hike priced into June and a little bit more than a hike price in July. So somewhere in middle to late June or early July is where the market is thinking that we're going to have, we're in either one of those meetings probably push back a little bit to July. The market's expecting that cut. You see here, the market still expects another cut in September and then another cut in either November, December. And as we've talked about before, Tony, as we
Yes.
get closer to the election, I think that's increasingly unlikely that we're going to see any Fed action in and around the election, especially in what is expecting to be a fairly contentious election. I would think that the Fed's going to, if they're going to do anything, they're going to try to do it this summer. But as you know, I've been talking all along that I really didn't think we were going to see any cuts this year. And interestingly, I saw my good friend Torsten Slok from Apollo come out and say that he doesn't see any rate cuts this year. And Larry Summers, who's never afraid to make some headlines, talked about what about the odds of pricing in a rate hike instead of a cut, which I don't think either of us see that's one of the outcomes here. But it's interesting how the narrative around the Fed has changed quite a bit, but it hasn't really impacted the market.
Yeah, Richard, I really like your bold prediction that there will be no cut for Federal Reserve point of view. But this is very bold prediction, and certainly agree that most likely we will not see a cut in September, just given that the time is so close to the election date in November. So most likely that I think the market anticipation in this case might see a disappointment for Federal Reserve to take meaningful action in September, but could be a one after election. And if Federal Reserve really need to take action now, May, June, and July, May and June might be the most likely the time that they can actually take action. This is if they really want to actually take action. The longer, the higher for the Federal Reserve's rate policy here. Apparently, to have the double side sword. One thing that we can actually think about that Federal Reserve take this kind of a hawkish stance simply because we had a strong economy. The economy is so strong with the shortage of the labor supply and with the AI and technology advancement, which actually might create some new opportunity and simultaneously increase or augment the productivity of those tech high-tech company, and some of the maybe what we traditionally think about the consumer staple and consumer discretionary company might also benefit from the AI adoption is AI technologies, generate AI in this case scenario. So that's actually from a positive side, but on the negative sides, we have continued to see the federal debt over the GDP ratio continue to goes higher, and also the numerical norm of the debt here for federal government continue to reach the new high. And if we continue to have the high for longer policy, that the interest payment as a percentage of the GDP might become an issue that we certainly need to actually think about. And apparently no government in the world in history can actually continue to borrow money to actually stimulate the market. I think the market continue to get a new high, benefit from almost the current fiscal policy from the government, certainly, that actually continue to stimulate the economy. This is definitely a good side, but how long and how fast can it go? This is a big question that we should really think is through at this moment, especially right now. Other country such as the countries in Europe, including both England and other countries, might technically actually get into recession. Now, with the engines like in the world, including both China and Europe, just falling into technical recession, how fast can the U.S. economy can continue to grow and simultaneously continue to make the stock market, equity market a new high? This is something I think the risks are accumulating here and becoming a problem that no one should ignore.
You're absolutely right, and I think I think we're adding debt to the deficit at about $1 trillion every 100 days. I think where the headlines that were coming out last week.
Right.
And perhaps, and that's another thing we wanted to talk about was the yield curve. I'm going to move over to the yield curve now and look at the 2-year, 10-year, which is I think what a lot of people tend to look at. And one of the things impacting this yield curve and why the yield curve is struggling to re-steepen is the fact that these rate cuts are getting priced out of the market, right? The market was starting to the curve was starting to re-steepen as cuts were getting priced in. It started to flatten out a little bit with the cuts being priced out. But I think a bigger driver of what's going on in the yield curve is where the Treasury's choosing to issue its debt, which is at the short end of the curve and not at the long end of the curve, which I find interesting because 10-year Treasury somewhere around 4.3, short-dated Treasury is still 5% or more, yet they want to issue it at the higher 5% short end.
Definitely.
Which is interesting because that suggests to me that they don't have enough demand to issue that debt in the 10-year. And maybe there are enough investors around the world that are saying we're not willing to fund this for the next 10 years. Maybe we're only willing to fund it for the next year or so. So that's
Right.
something that I think is definitely on the radar and something we need to worry about, because that's the potential for liquidity to really drive up quickly if they're unable to continue to fund themselves there.
Definitely. Since I think the last December, when Federal Reserve start to actually pivot in their tone over the FOMC meeting, that we continue to see the improvement over the liquidity in the financial market, which can be illustrated from the financial condition index. This is apparently a great news for the equity market for investors investing into the U.S. at this moment. But if we continue to see the higher for longer, the scenarios coming to happen, and given the situation that accumulated risk building onto both bond market and equity market, this also definitely is, I would see, we could possibly see some of the correction or retracement kicking in, especially now we do see the bubble in other asset class such as the cryptocurrency, right, from the Bitcoin and Ethereum. I think in early this year, when we actually caught the right things about buy on rumor, sell news on Bitcoin. Now here is like apparently the crypto market has almost finished a full cycle, turning over from sell news to right now reaching to an almost close, picking up to new highs, which actually was like a $67,000 per coin for Bitcoin, historically. Now the market, the crypto asset investors really anticipated that SEC is going to approve a series of ETF based on the Ethereum, which might be the second largest crypto so far. Now this is actually power up all of the enthusiasm into the crypto assets. This is a very typical scenario, or very typical narrative about the market bubble in crypto assets at this moment. And we can actually see that from what we have seen in the crypto market, that is telling us then the liquidity situation is actually in a well situation. Apparently, we don't actually see the tight credit or tight liquidity situations in the financial market at this moment, but things could change anytime.
Yeah, I agree. One thing it is surprising, as we were talking offline, the crypto market is definitely on fire, and it all, going back to or near all-time highs. Of course, stocks are at all-time highs. I just want one last thing on this yield curve. We can see that we first inverted kind of back here in July of 2022, and as we know, the yield curve has a great predictive power, but it's with a variable lag, and that can be anywhere from 6 months to 30 months. On average, it's somewhere in that 18 to 24-month range, which would put it somewhere between January and July of this year. So we're kind of right in that sweet spot. If we're going to have a recession, if the yield curve is going to continue as 100% hit rate, we should have a recession here, and maybe that would help people with the rate cuts, but that wouldn't help people on the growth standpoint. But again, that doesn't seem to matter for crypto, because as you mentioned, Bitcoin definitely seen the benefits of the ETFs. I mean, I think there were a lot of naysayers early days because it was unclear with a lot of the money coming out of the Grayscale trust and going into others. It looked like it wasn't as big as possible, but in the last week or so, we've definitely seen money flowing into Bitcoin, into the ETFs in a pretty big way. And now, like you said, the Ether ETFs, I think VanEck has one in front of the SEC that's supposed to hear back by May 23rd.
Yes.
And so I think that is the catalyst that people are looking at in Ethereum and the Ethereum network. But of course, Bitcoin, we also have a halving coming up sometime in April. And so that's another potential catalyst. And so there is nothing but good news in those kind of major coins. But it's not just the major coins, it's everything that is rallying to the moon. As you can see over here on this kind of far right, pretty much every coin that Bloomberg tracks is at its highs of the last 30 days, which is for the most part putting most of them at the highs that they have been at. And so that is definitely a sign of exuberance. And I think the Bitcoin dominance index is something you probably look at, but it clearly we see that when crypto investors are feeling confident, they're actually moving out of Bitcoin and into these other altcoins and other sorts of names for them. So it maybe we're not seeing that impact Bitcoin as much because more traditional investors are coming into Bitcoin, but the crypto investors.
All right. I think in old school, especially in the financial world, we have a very nice slant calling a double is a bubble. Now we have seen a lot of this kind of altcoins actually double over the past few days, and even maybe just 1 or 2 weeks in time horizon. That's actually telling me that there is a bubble apparently in the crypto market at this moment. Those two catalysts that you mentioned, Bitcoin halving and also the ETF approval for Ethereum might actually be materialized, but we possibly are going to see a repeated pattern. This is what we have discussed about the approval of the Bitcoin ETF right at the beginning of this year. So this is very likely the patterns. A bubble is a bubble. So that's the science of speculative.
Absolutely. But it's not just in crypto we see the exuberance, we see it in stocks too. But that
But
perhaps I'm looking at the now I'm brought up the earnings season recap for the S&P 500. And we can see that most of the market, like 490 of the 500 companies, have reported at this point. And again, it was a pretty solid earnings period. So even though the stocks are at all-time highs, they're being driven by earnings, which were much better than expected and are showing some pretty solid growth here of just over 7.5% earnings growth, almost 4% sales growth. And you can see that that's not every sector. Of course, healthcare is struggling a little bit. Energy materials are struggling a little bit on terms of the growth. But if we look at it from a surprise standpoint, that slower growth was expected in those sectors. And really, from an earnings surprise standpoint, while the sales aren't really surprising that much across the board, earnings are pretty much surprising positively across the board, across every single sector. And that's what's leading to a little bit more breadth in the market right now. I know in some ways we've actually seen a little bit of a rotation out of the Mag 7 into other parts of the market as investors are again, much like in crypto, they're selling out of their Bitcoin perhaps and moving into altcoins. In the equity market, we're seeing a little bit of them selling out of the Mag 7 and moving into other areas. And that's because we've gotten plenty of earnings support to suggest that that's the right thing to do.
yeah, Rich, I really like to add that you actually bring this page up. By looking at this page, we can see the financial industry, financial sector really have a very positive earnings surprise in the current season, over almost the second highest one out of the consumer discretionary, that actually also becoming a catalyst for the financial sector continue to go up. Normally, the financial sector would outperform only in the scenarios when either we would not see a recession because that given the scenario, we continue to see the strong economy or GDP growth. Now, this actually might corroborate with what we have anticipated so far. The soft landing or even no landing might be the most likely scenario that I think the market is really discounting. This is really baking the scenario into the financial sector's performance as well here. This is what we have seen here.
Yeah, I would agree. This definitely looks like no landing, right? When you're talking about consumer discretionary, financials, and energy, that is a scenario that we see that those sectors leading the way when growth is strong and inflation's moving up too, right? Because
Correct.
energy and energy stocks certainly need to see some inflation to benefit in, and usually you're going to get that same with rates moving higher to help benefiting financials. But yeah, financials, the second best sector, and I think if we drill into consumer discretionary, I think it was basically across the board too. It's not just Amazon that was
Yeah.
driving that, and so I think that is definitely something that is worth knowing. And I just wanted to bring up one other screen, which I've kind of shown before, and this is the relative rotation graph. I'm just looking at the different sectors within the S&P 500, and we can see we can see some of these like consumer, some of the defensives have been kind of moving up, and you see energy starting to move from that lagging sector, starting to move in the improving sector. We still see tech and financials over here leading the way.
All right.
That's probably got some, I think most people, a lot of people, especially the naysayers, would tell you that this is really only a market being driven by 7, maybe even 5 names. And I think that had been the case there for about a month, but we are seeing a broadening of that in the last few weeks. And I think that's something we need to pay attention to, because we can see how powerful that was at the end of last year when the market rally broadened out and so many stocks, so many sectors, so many indexes moved to new highs by the end of the year.
Yeah, Rich, if you actually recall that what we discussed in last episode, that we have seen some kind of very risky movement taken or action taken by the university endowment, including the Harvard endowment as well, just maybe concentrating their investment into the M7, which has been a very typically a great indicator that maybe the momentums behind the M7 is diminishing. Sometimes we do, especially when the M7 is such a big tech, large cap tech, require a lot of a huge momentum, or like a force, buying power behind them to continue to push the capital or price asset going higher, either from the better than expected earning or either from the sentiments among institutional investors here. So we pretty much, I think, from the sentiment of institutional investors, we have seen exhausting or diminishing impacts from over there. That's actually might be warning signs for us, especially for investors who really just focus on the M7 investment.
Yeah, I completely agree, and that may be a good. It's always a catalyst when you see that slower, bigger money kind of move into something. It might be time that's probably getting closer to the end than the beginning
Correct.
of the trade. So yeah, we've definitely seen that, and I think you mentioned right there some of the things that might be driving some of those decisions is this momentum factor. And as we can see over the last 1 year, and certainly on a year-to-date basis, momentum, if we're now I'm looking at our Bloomberg factors to watch screen, and I've neutralized it by sector, so we're not seeing a sector effect in here. We're just seeing the factors. Momentum is definitely the best performing factor that we see, across funds, and so
Certainly.
in some ways not surprising to see those endowments and funds moving into stocks that have exposure to this momentum factor. I know a lot has been written about the markets and how the influence of passive investing might be leading to more and more prominence of the momentum factor versus the traditional mean reversion that we might expect to see when active asset managers and hedge funds are more active. Right now, it's a momentum game, and momentum is working. And the other thing that's working that's right up there at the top is size. And so it's not
Yeah.
just momentum, it's large cap. It's large cap
Large
momentum,
cap
and
momentum.
earnings revisions are driving the bus. And if you're a value or dividend or quality name, you're probably being left behind right now.
Correct. So we definitely continue to see that NVIDIA, Meta, those continue to actually power up the market. Certainly within that sector. We're not actually just talking about those kind of individual stock, but this is the factor by itself actually behind the market movement.
Yeah, and here I just moved over. That was a long only screen where it's really kind of trying to get exposure to the largest names by that factor. Now I'm looking at a long short screen where it gets long the best performers and short the worst performers, and the performance is even more pronounced, right? And so
Right.
it's not just that the names with the most momentum are doing the best. The names with negative momentum are actually underperforming by quite a bit too. And so
Yeah.
the same thing, momentum revisions and size, large cap that is, are where you want to or where people are choosing to be long, and dividends and value are where people are choosing to be to not be exposed right now. And so that is definitely a bigger piece of the pie when we look at that. And so that's something that certainly it has been super important. I wanted to scroll one last thing as we're talking here, Tony, then because we wanted to talk about the dollar, but I wanted to look at how this is working in terms of global markets, right? Not just in the U.S., but how does that work on a global basis? See if Bloomberg's got that. Maybe Bloomberg doesn't have that as I'm looking through here, trying to see how the factors are working on the global markets. And yeah, we can see that again, momentum and revisions are definitely working in global markets. But I bring that up because one of the things that we were talking about was the dollar, right? And the performance of the dollar. I have a little bit longer term chart here to give it some perspective. The dollar's been a little bit sideways the last year, but it's hanging in there. I think the market was expecting it to be a little weaker as the Fed was expected to cut rates. Those
Correct.
rate cuts that we started the show at and start talking about the rate cuts being priced out, well, that supported the dollar. And as we know, and we've looked at it before, when the dollar is strong, it tends to benefit U.S. assets relative to assets around the rest of the world, especially when we're talking about emerging market equities, emerging market bonds, emerging market FX. So U.S. stronger dollar tends to benefit U.S. stocks and bonds relative to especially emerging markets. And I think that's what we've seen in the performance this year. I know a number of people have been saying that emerging markets might be the best catch-up trade that they can see, and it's clearly lagged the U.S. by quite a bit over the last several years. But with the dollar holding strong here, I'm not so sure that I'm convinced that emerging markets, other than a select few, like we've highlighted India several times, but as a broad asset class, I'm not so sure emerging markets have that catalyst that they might be looking for just yet.
Yeah, Rich, 100% agree with what you're just saying. This is at with US dollar actually remaining above like 100. Typically, it's a bull and bear line over here. Then we definitely see a strong US dollar index, which indicated that the global investor would actually favor the asset classes in the US market at this moment. But it's reaching to a very critical point that either it might actually, from a technical point of view, Rich, you are an expert in this, so I will not get into the technical. So it's once actually it definitely reached into a critical point with regarded to the action that could possibly be taken by Federal Reserve, which actually might have a huge impact and causing the volatility spike into the market. This is actually we are very close to that moment. We have continued to see the volatility reach into very, very close and remain low for quite a long time. But from a market participant point of view, this will not be always the case. And any black swans event happen, then in this point and at this moment can cause a turmoil in the financial market.
Yeah, I completely agree. When we think of the FX markets, I mean, oftentimes the textbooks would tell us that interest rate differentials matter a little bit, and they do to an extent, but I think that's largely priced in. It to me, the two things that drive the FX market in the long term are relative return potential, right? And the
Yes.
investors, they're not looking, the FX market is a derivative market, if you will, and investors are really focusing on where they think they can get the highest return on their money and in which region, and that's going to impact money flows longer term. But in the short term, as you said, it's the technicals that matter the most. And I think, as we were talking here, and I'm looking at our dollar index screen, I just drew a few lines, and it looks like a falling wedge is if we don't get into technicals, a falling wedge is setting up here, and somewhere around 104 is where the kind of the declining trend line is coming in, and the support somewhere around 101 and a half. And so we're in this tightening, consolidating range. And if the Fed in its meeting in a couple of weeks sounds hawkish at all, we could see a potential breakout to the upside. And I think that, to me, Tony, is, even though I know stronger dollars should support U.S. assets, I think as we saw in 2022, the higher dollar causes some disruption in global markets because there are so many companies that have borrowed in U.S. dollars against their revenue stream in the U.S. And so higher for longer, higher higher rates in the U.S. What that does towards Treasury refunding, what that does towards the shortage of dollars amongst corporations, and could we see a return back to a little bit of the volatility that comes from those moves when we get those short rapid bursts in the dollar, which are never really good for risk. And with credit spreads at 20-year lows and volatility measures somewhere around the lower end, certainly more than one SD below the mean. It doesn't feel like the market's pricing in potential risks, but there might still be some risks out there. But that's what we do for a living, Tony. We like to look at where there potentially are some risks coming in. But right now, kind of ending it here, it doesn't seem like investors overall see too many risks out in the market, whether we're looking at equities, looking at credit, or looking at crypto. It feels like it's risk on everywhere we look, but that doesn't mean that there aren't some warning signs to be worried about there.
Exactly, Rich. I definitely, this is from now on, we should just maybe wait for the FOMC meeting just in the coming weeks. At the moment that we would actually have a clear picture of what kind of actions the Federal Reserve is going to take.
Yeah, the March 20th FOMC meeting, and as we're talking, I'm just bringing up the credit spread graph that I talked about before, and you can see this is just the Moody's corporate credit spread, and we are near the low levels that we saw in 2005, 6, 7, and so something again doesn't mean that anything imminently has to happen, but it does mean that there isn't a lot of margin of safety out there when we're looking at across a number of different risk assets, and with With March coming up, March is always a month that it's historically one of the better performing months of the year, except for when we've had a really strong run in January and February. I just saw that chart courtesy of Bespoke Events Investments. We're saying that when we've had a good January and a good February, March tends to have a pretty negative outlook on a seasonal basis, and we see some of these risk flags that are waving to us out there, even though it's definitely risk on when we look across the markets. Any last words for us, Tony?
Yes, I think right now the market sentiments and also the corporates earning with also expectation that Federal Reserve might continue to cut together with the strong economic growth, just explain the current rally in the U.S. market. But simultaneously also highlight the market's like greatest weakness here. It's like a heavy reliance on the belief in this kind of a low policy rate and strong economic growth. And everything just must go exactly right in terms of either low inflation and also simultaneously the corporate earning together with power up by the AI disruption. So everything must go right. And this is right now we have priced in a perfect situation, a scenario, which most likely is going to end up with a disappointment. And as what you just point out, which we have very nice January and February, then tend to actually indicate that we are going to have a very nice year overall. But most likely, we're going to see the seasonal correction in the coming season. So sell in May is into the game now.
Yeah. Sell in May and go away is definitely into the game. And as I wrote about this weekend in my Substack, normally we talk about how March comes in like a lion and goes out like a lamb. Well, right now it's coming in like a lamb, so maybe it's going to go out like a lion. So we'll have to kind of keep our eyes on that.
Exactly.
But as always, Tony, we're going to try to stay vigilant, right?
Yeah, always stay vigilant, especially at this moment. Yeah, very important.
Okay, thanks everyone. We'll see you in a couple weeks where we'll be probably previewing the FOMC meeting, which will be happening that week when we meet again. So until then, again, try to focus on the macro that matters. And as always, we like to stay vigilant.
Yeah, thank you everyone, and look forward to seeing you in a few weeks.